Good afternoon, everybody. Thanks very much for joining this, which is one of the sessions as part of Day 2's program of events coming live from EXPO Real here at the International Investors Lounge. Thank you to everybody who's joining us here. Thank you to the speakers, and thank you to everybody joining us online. Super panel here to look at some of the key trends in terms of the investment outlook, what we're seeing in the market. For those who don't know me, my name's Richard Betts. I'm head of content here at Real Asset Media. We publish 3 different journals, Insight, Impact and Real FDI, looking across, I guess, some of those key areas in terms of the market, but also looking at foreign direct investment trends around that, locations, and also ESG, sustainability. So picking up on some of those key drivers for the industry, and our focus is very much on the things that are driving the market. So research, analysis, insight. So less looking back, although I will probably ask a question about looking back, but more about what's driving the market. Let's just do some quick introductions. So Dan, over to you. Quick introduction of yourself and your role there at LaSalle.
I'm Daniel Mahoney. I lead LaSalle's European Research and Strategy team.
Great, very succinct. Marcus.
Marcus Cieleback, Chief Urban Economist at PATRIZIA.
Great. Alice.
Alice Wilcox. I'm a Managing Director in Alternative Capital Formation at Goldman Sachs on the asset management and wealth side.
Great. Tom.
Tom Leahy, Head of European Property Research at MSCI.
Kept it succinct. And if anybody has any, if it gets louder and it's difficult to hear, let me know and we will try to adjust everything. So unless I hear from you, I'll assume all is good. Let's pick off, as I said, what is the difference? Where have we changed since 2023 here in Munich? So what have you seen as some of the key trends? And I'll set a rule, which is you don't need to wait for me to ask you. You can come in, and also this is true of everybody here. If you've got questions, do let me know somehow that you've got one, and we'll make sure that we also pick up on yours and also yours online. Let's maybe start with you, Alice, just on that in terms of what's the difference? What are the changes that you've seen over the past 12 months?
I think generally most people would agree there's green shoots. You've seen interest rates come down. So I think there is a little bit more optimism in the market, but I still think there's quite a big bifurcation in terms of what people want and what people can demand. So, there's still some challenges around some sectors, whereas some other sectors are starting to see some strong headwinds, particularly where there's kind of an underlying fundamental reason for it, demographics being a very obvious one, for example.
Okay, good. And Tom, over to you. And it'd be interesting actually also to pick up from anybody, whether there were, as well as what you see, whether there was anything that surprised you, I guess, anything around that.
Yeah, I think this time last year, people were still feeling pretty pessimistic about the outlook for real estate. We were still in the midst of a slowdown. Values were still correcting. I think this time around, at MSCI, we've got a lot of data on the transaction market, but also on the valuation side of things. And both those data sets show a stabilization. So it looks like most of the correction in capital values, with the exception of offices, as most of that has come through already. Offices still on a slight different trajectory. We're also seeing a stabilization in the transaction market, so more deals coming through, but it's very focused on particular sectors. So living, for example, as being a part of the market where we're seeing quite a lot of transaction activity. The reverse of that is clearly the office sector, as I've already said, where I think office volumes in the first half of the year were as low as they've ever been in Europe. So that speaks to that bifurcation Alice mentioned as well.
Maybe I think one of the differences is, or what has changed, is buyer and seller expectation are coming closer together now. I think we have seen some correction that helps to expect some liquidity coming to the market. But what I also feel is, talking to many players, that we still see addressing the structural changes and how they will impact the markets going forward. We were used to structural change in retail for a couple of years, but now with what type of offices, what type of locations will be going forward, how will that structural change evolve, is some of the things I think people are still in the process of understanding. And therefore, I think it's a place where we now see one end of the market where the quality stock is. There we see the green shoots coming, and the rest where the structural change is impacting stronger. There is still a lot of understanding and working on the consequences.
And it sounds like what you're describing, it's very much the looking ahead. And right, as we think about the real estate cycle, it has no end or beginning, but sentiment certainly, it reflects those moods. And if you think about a year ago, we were just in the thick of a correction for real estate. And this year, it feels much more like thinking about a beginning of a new cycle.
And I guess, were there surprises for you within that, whether that's the occupier side or the investment side, the things where you thought, okay, well, I wasn't expecting that. What sort of surprised you, I guess, if anything did, Dan?
On the occupier side, I think we have had a few surprises looking at this year. In particular, a positive surprise in some office markets, especially thinking about that top decile, top 10% of offices by location and quality. We've seen several quarters of declining vacancy in the City of London, which we wouldn't have expected a year ago.
Okay, good. And maybe, Alice, just to pick up with you, I suppose, what are investors looking for? Feel free to pick up on whether there's a change there, but looking at the market now and looking forward, what are investors looking for from their real estate allocation? And I suppose, what does that mean in terms of the trends that we're likely to see?
Yeah, I think real estate has always been an important part of many client portfolios and has had an important place. I think we're seeing some investors, I know this is a real estate conference, but combining real estate and infrastructure, and there are certainly some sectors where there are parallels, like data centers, and again, some of those mega trends would go into both, like technology, etc., that would fit across both. I think what we've seen is a lot of investors have sat on the fence over the last couple of years. They may have had to address challenges in their portfolio and work out a new strategy. And I think we're starting to see valuations come through, correct pricing, and they can kind of work out now where they want to go. I think return expectations, though, have moved. So people talk in real estate terms about core plus, value add, opportunistic. I think we need to keep in mind that people are wanting a little bit more from real estate in this new interest rate environment. And so we're all going to have to manage our expectations about what we deliver, what we can underwrite, and continue to deliver that. And again, I can't verify, you'll probably know this better than I do, Tom, but every manager I speak to who has core, semi-liquid, open-end funds, they definitely feel more optimistic about the redemptions that they may have had coming to an end and actually starting to see increased investor activity, which is a sign that I think, again, those green shoots are starting to come through into the market.
Yeah, it's interesting that view around the green shoots coming in, and certainly I've been picking that up in the discussions I've been having here. And feel free, anybody, to pick that up. But Tom, I wanted to pick up with you because you were on this panel last year, as you mentioned. And at the time, it was survive until 25. And even nix until 26 was the kind of view. But here, if we're already starting to see green shoots, do you think there's a general sense that we're maybe being too positive, or that actually this will come through more in 2025 than actually people were expecting? What's your sense of that?
I mean, I never need an excuse to be pessimistic, Richard. I'm from the north of England, where, we're sort of born pessimists.
Yeah, it's all very bleak, I know.
Yeah, it is bleak up north. So I don't think I'm not generally accused of being too optimistic, but I think things are improving. But I think the point Alice made is about the industry has to sort of reshape itself and redesign itself, because the last 10 years were almost the sort of the opposite of the perfect storm for real estate. You had the perfect confluence of structural factors, but also the impact of exceptionally loose monetary policy that pushed all this money into real estate. That has now changed, and so the industry has to adapt to that and change to that and adapt to what investors require from it, and that's, I think, structurally higher returns. And it's how, once we get, there's going to be a boost to the market from falling interest rates, I think, and that's coming through, and we're seeing a bit of that already in the deal volumes. But once interest rates stabilize at a higher level than they've been previously, it's, how does the industry provide the returns, as Alice said, that investors want? So I think you can be cautiously optimistic while also realizing that there are challenges how property adapts to this new environment.
And maybe more investors want more in 24. I completely, Alice, that I completely agree with that. And I think what that means is higher income return, higher overall expected return, and than we were 2-3 years ago. And increasingly, I think we're getting to that position where real estate is able to offer that forward return that's back between similarly risked bonds and expected stock returns. So that's a place where we got away from and are now getting back to in terms of where we are in the cycle.
Yeah, I think on the one side we are getting back, but also I think we have to keep in mind that going forward, the investment world will be a different one than to the ones we've used to 3, 4, 5 years ago, because we don't see the zero interest rate environment returning, so a certain group of investors will not return, and therefore the fundamental way will be much more important. And at least what I see when talking to a lot of investors, they still struggle with that passive over-allocation to real estate due to the collapse in stocks and bond markets in 22. 23 didn't remedy all the misallocations they had, and now they realize possibly some of the portfolio they like to sell or like to reposition is exactly the stock where the market has not opened up yet already. So I think this is still, there is the optimism for the good quality reallocation for the portfolio, but on the other side, there is still the challenge to find the pricing for the other end to open up a much more liquid transaction world going forward.
Okay, good. I wanted to pick up a little bit the geopolitics, which has obviously was one of the big topics, and has not improved in some ways, I would say. So maybe Tom, starting with you, just in terms of the geopolitics, I guess how do you see that influencing things? Have investors really just got used to that instability now, and that is priced in, and there's an expectation that there's nothing you can do about it, and so therefore you have to invest around it? What's your sense?
Yeah, leave me with the easy questions, Richard. I think it's very difficult to model something. If you think about the conflict that's happening in the Middle East at the moment, and you look back to the last parallel, which was the Yom Kippur War in the 70s, the oil price quadrupled because of the Arab oil blockade. So it's very difficult to model that through a real estate investment process. If that, if something similar happens, if the Iranians block the Straits of Hormuz or something like that, that's a sort of worst case scenario. So it's just very difficult. I think you have to adapt to a degree of uncertainty, and maybe greater geopolitical uncertainty than we're certainly used to in the last 10 years. If you look at, there's a geopolitical risk index that's produced by some US, they're sort of academics linked to the US government, I think they are. And that's since the start of 2022, so Russia's invasion of Ukraine, that's been running at a sort of 50% increase on the average of the last 10 years. So that tells us we're living in a world where there's greater geopolitical risk, and that ultimately will impact decision making at a macroeconomic level, but also impact commodity prices, and that ultimately will feed through somehow into the real estate market. But I think it's, the investors can talk to this in more detail, the managers can talk to this in more detail. It's like, how do you actually deal with that instability in your real estate portfolios? I think it's quite difficult.
It slows everything down.
Yeah.
I mean, from transactions to commitments to a lease, that uncertainty really draws out those processes. And one area where I think you might take a view on higher geopolitical risk is that inflation, the risks are to the upside long term. And that certainly would impact real estate cash flows.
I think the investors starting more to look at how can they position their portfolio from a resilient point of view, which sectors are the ones that provide the stability associated with the real estate investing there. And then it's possibly more talking about downside scenarios than about the upside opportunities to deal with the geopolitical side of the coin.
I think that's interesting. And maybe let's drill down a little bit into those resilient sectors. Obviously, there's been a big focus on logistics and on everything around the living sectors. And you mentioned as well, Alice, that crossover with digital infrastructure funds more broadly, and data centers, and those kind of larger macro trends that are driving things. But what does it mean? Maybe let's start with you, Daniel, on this. What does it mean, and are there differences? Obviously, we had the view of the office apocalypse in the States, but a different view here. So, how do you see Europe within that kind of global context as well?
Well, stepping back, I think diversification, so having exposure to many different property types, geographies, and strategies is valuable. Although in the last several years, the outperformance of some property types, like logistics, has been so massive that the view that you could pick which property types are going to do better, I think that view is a really strong one at the moment. But we shouldn't forget the power of diversification. So putting these things together, when you can't predict the future, it's good to have an allocation to many things, including office.
Okay, good. I suppose, Alice, from your point of view, if we're looking towards the investors, I guess, what are the funds looking to deliver? And I suppose, what are the funds looking for as well? So from your perspective, how do you see that? And also, I guess that brings in the core investors of the future. What's the sentiment there? What are people looking for?
I mean, the two areas that we have been mainly working with our clients recently has been being an alternative lender, so real estate credit funds, both in the kind of senior whole loan position, but also high yield lending in a senior position, and sometimes some finance, so sometimes providing mezzanine financing, for example, on stabilized cash flows. We've seen a growing investor interest in that as a diversification, particularly away from private credit, and also just seeing better risk-adjusted returns in this period where valuations were a little bit uncertain. And within that strategy, there is a place, for example, for office, because actually there are some markets, as you were saying earlier, where we've seen rental growth, there's a lack of supply coming through. But also, there's, again, back to that point earlier about the bifurcation. Occupiers still need somewhere to be. People are still going to the office. And I think the trend we've seen working from home has probably reached its bottom. I think people are coming back into the office more often. The other area we've particularly been working with our clients is real estate secondaries, where we think there's a very good opportunity in this market to provide capital solutions to both GPs and LPs who might need liquidity at this point. And we'll still look for the best manager, we'll still look for the best strategies, the best sectors. But those are two areas our clients have worked very closely with us to execute on.
Okay, interesting. Let's drill down a bit into that idea around the best strategies, where the best opportunities are. Let's pick on that. I mean, anybody can start, but Dan, do you want to start on what you're seeing in terms of the investor strategies and maybe the opportunities at the moment in Europe?
So maybe to focus on some that might be a little bit edgier out of consensus. I mean, we've certainly seen an improvement in the outlook for retail strategies over the last year. And that includes, a niche we really like within retail is outlet centers, but includes other types of retail as well. And I think it speaks to the fact that it's going to be harder to pick one property type that's going to blow away all the others in performance going forward. Mm-hmm. And so it's worth revisiting some of the things that made a property type like retail attractive.
I mean, historically, PATRIZIA, we always had looked at the European residential markets, and residential has been a favor of many institutional players over the last, let's say, years. Nevertheless, when looking at the sector, today we talk more about living than about residential. It's much more diverse today. And it's quite hard to say favoring one city over the other. It's maybe just to understand what type of risk profile are you willing to go for at the end, because there is the undersupply situation we all understand, but that is also associated with regulatory interference from the governmental side, and you need to understand the rules of the game if you want to play that game. And some investors have seen over the last 2-3 years that stability of regulation is not what it has been in the past. And at the same time, and that was the funny thing when we looked at the sector, today we have the opportunities that come from political interference 40, 50 years ago, because there is this brown to green opportunity you might have, there is this kind of affordability opportunity. Both are the results of political activities that go far back 30, 40 years. So we need to really better understand the complexity of the drivers and position then according to risk return, because a development strategy in many cases might be feasible. The only question is which segment you really want to target, because regulation limits your ability to go on every element in detail.
Okay, good. And in terms of sectors, Tom, what are you seeing in terms of your analysis? Are you seeing more of a focus or growing focus on some of these other areas? Potentially as well, like you've got things like senior living, without maybe the operational medical side crossing into healthcare, but you've got that because of the demographic shifts in Europe. But are you seeing that coming through?
Yeah, if you look at the transaction activity at the moment and where volumes have been relatively robust in the first half of the year, a lot of that has been in the living sector. So there's a bit of rebound in demand for hotels as well, especially in UK, but also in Southern Europe. I think slightly different drivers, but that's a part of the market that really struggled during the pandemic, obviously, but there's been a very sharp rebound in tourism numbers. I think tourism arrivals in Spain last year were ahead of where they were in 2019. So the occupier side of the hotel sector seems to be holding up very well. Yes, you've got all the demographics, I think, in the affecting demand for living sector, urbanizations, pushing people into cities. In terms of the opportunities, though, I think I still, if you think, office investment is at its lowest ever and lowest ever point, there will be opportunities, I think, to outperform if you can get the right office in the right location. There's some distress coming through in the office sector as well, so you're seeing forced sellers. You're also seeing people to bring properties to market which require capital expenditure, but maybe they're not willing or able to undertake that work themselves. So I'm sure there are going to be some smart developers or institutions who are going to make quite a lot of money by buying offices over the next probably 24 months at a point when a lot of other players have left that space.
Okay, Alison, are you seeing anything in terms of the capital flows, the capital raising side, that I guess indicate where some of the investors are looking and seeing those opportunities? You mentioned debt already, but any other ones?
Yeah. I mean, I think this has been a very LP-friendly market, and a lot of clients can, direct the capital that they've got into certain very attractive opportunities. And I think, to what Tom's saying and my other panelists, living is definitely an area where, again, as I've said earlier, there's structural reasons for it. I think logistics, is still a favoured sector. We're still seeing that kind of e-commerce penetration. I think leisure, so hospitality, again, people still wanting to go on holiday, still spending that capital. Again, I think clients are talking about those sort of areas. But to your point earlier, I have heard increasing interest in retail, because it has been an out-of-favour sector for some time. You're now going in at, stabilised assets, 100% leased, tremendous performance, opportunities around these assets, but just a capital market dislocation. And it's become such a small part of client portfolios. There are places where it makes sense to add that in. It is yeah, I'll leave it there.
Okay, interesting.
Yeah.
I think that's it. So you've picked a winner there, Daniel, by the sounds of it, which is good in terms of the retail side. It would be good also, I think, just to pick up a bit on some of the locations. We're obviously here in Germany, so the context of that, how you're seeing Germany versus the others. I was also at a session looking at Portuguese real estate 2 weeks ago. Very buoyant market there, and also a sense that if we look back to Portugal, Ireland, Greece, Spain, the pigs, as they were called then, are the pigs flying now? Was my question in that topic there, and harking
that is a cheeky question.
and harking back to the front cover of a Pink Floyd album. But so, what's your sense of the dynamic between Northern Europe, maybe also Central and Eastern Europe, and Southern Europe, for example, in terms of where you're seeing the momentum?
Spain has been a very strong performer, and in part that's tourism. Tourism has been a big driver of that economy, and that is a place where we've seen more opportunities as a result.
And in terms of, I guess the UK versus France versus Germany versus the Nordics, how do you see those? Do you view them as, I guess, I'm looking at the UK market, or are you looking at specific cities, or are you looking at actually micro locations within them? How do you see that in terms of the research side?
I think it's reductive to even talk about which country is going to be the best performer relative to another. I think we're real estate people, so we know it's all about location, and so I think drilling down to that location and our recent logistics analysis on the paths of distribution, we're looking at a hexagon that's 10 kilometers across. I think you need to get to that level of detail.
I think at the end, if you believe in urbanization being one of the drivers for the real estate sector going forward, having the country view, you are missing the crucial element, what will drive the real estate sector at the end. So you definitely, if you look at classical office, high street retail or resi, you have to look at the city level. For logistics, it's definitely more spread because you also have the connections to look at. But it is the city level you really have at least to understand to define the locations you want to go to.
But does that mean, for example, that you're taking less weight on something like GDP, economic growth figures? Because obviously you've got Germany, which is in a worse position, let's say, than some of the other countries in terms of the growth perspective right now.
I think if you look at country level growth, Germany definitely has a challenge to manage. But if you look at city level growth, the picture already is changing. So I think you really have to distinguish between the country is the average of a lot of things happening in rural areas and urban areas within the country. And I think Germany we have regions where structural change is an issue and that are holding back the overall economy, while some of the city areas are seeing a solid, not a buoyant development in a European context, but they have a solid development, and that creates a demand side justifying positioning in these areas.
Okay, interesting that there's more of a disconnection now then between real estate investor views and also those kind of broader macroeconomic views. Let's pick up a little bit in terms of the markets. Tom, what are you seeing? Are you seeing anything in terms of the deal flow that is suggesting anything in terms of more of a focus in one area than another?
Yeah, I mean, I'm reluctant to talk about at a country level now, but yeah, if you do look at, because I completely understand the points the panel is making about real estate as a local business, and you have to understand local market dynamics. And you only have to, this is a brief discussion, you only have to look at the different trajectory that the London office market took in the last 14 years or 15 years versus the UK regional office market. They completely diverged, having spent the previous 10 years more or less moving in harmony with one another. So and then there's all divergence, within London, street by street. So yeah, I take that point. But if you're just thinking at a more macro level, like where the recovery in transactions is happening fastest, it does seem to be in the UK. You would say, if you look at the trajectory of deal making in the UK versus France, Germany, and the Netherlands, let's say, it's been on an upwards trajectory in the UK for probably the last 9 or 10 months. That's not been the case elsewhere in Europe. And I think there are some factors that feed into that. I think one of them is the valuation regime. I think notoriously in Germany, the valuation regime was much stickier. In the UK, we saw a huge correction come through in, I think it was October of 2022. And so that, I think, has allowed the market to reset and has pulled some capital in a little sooner than elsewhere, than where valuations maybe haven't shifted as much. And there's still that large gap between buyer and seller price expectations.
Okay, good. I wanted to pick up on, we've got a session coming up on sustainability, both initially in the logistics side, but also more broadly picking up as well then the social impact side. And obviously that's a key trend, but it would be interesting just to get your perspective on that, how you see that from within the investment context. So I don't know who wants to pick that up first.
I mean, we have, over the last few years, we've been developing a portfolio of logistics across Southern Europe and France. And part of our sort of thesis was to develop energy positive logistics. So really, really focus on every aspect of sustainability in those buildings to meet the occupier demand. And, the thesis was that tenants will pay higher rents and, the occupier side will be stronger. We're at the point where we're leasing, and we're starting to see a bit of that thesis come through. So I don't know if the data is, if you're agreeing with that from a data side, but from an investment side, that is starting to come through.
Yeah, we've done some analysis looking at office markets, because that's where you have the most sort of consistent and broadest data set, and dividing the market between buildings that have environmental ratings and those that don't, and running them through a model that controls for other factors that impact property pricing, and that suggests that there's a premium being paid for those better quality buildings. I mean, it's not, the model isn't perfect, so it can't completely isolate whether, two identical buildings, one with a lower carbon footprint than the other, will gain a higher rent, but all the other, the data seems to be pointing that direction, that there is a bit of a polarization happening. But that also speaks to just, I think, a general preference for quality in the office market in general.
I think what you have to understand is where are the tenants are willing to pay for the quality of the asset. At the end, it's about a willingness to pay and also an ability to pay, because I think when we look at the commercial segments, the ability to pay is much higher and the willingness to pay is there. If you look at some of the living sectors, there is the challenge of the ability to pay. They might be willing, but they don't have the funds to pay for. So I think we see also a little bit of a development of which are the locations where it pays off to be green to a certain extent, and where are the locations where you know that you have legally to position your assets in a certain way, but you have to be very careful about what to do and what pays off ultimately, because there possibly isn't that rent premium associated due to structural shifts that these locations are not in demand anymore.
As a researcher, I'm obsessed with data, and I think we still have a lot of data challenges in terms of assessing where that return on cost is. But we've seen massive improvements, I would say, and that's whether that's doing net zero carbon audits on our own portfolio or it's market-wide data. So LaSalle and JLL work on a real estate transparency index every 2 years, and sustainability has become a key driver of how countries are moving in that ranking. And there really have been positive steps on just deepening the amount of data we have in that area.
And do you think this is an area potentially where real estate is ahead of some of the other markets potentially? What's your sense of that?
I think, Alice, I'd be curious to get your perspective on this, but I think as real estate, we have a claim to being the most transparent private markets asset class. Significantly more transparent. But What's your take on that?
Yeah, I mean, I think buildings are just such a massive contributor to a lot of the sustainability issues that are, we all know about. So I think, and we've seen a lot of investors, give it much more weight when they're making portfolio decisions. So it has moved the industry, in that direction. I think there were some investor surveys that were put out at the beginning of this year, and maybe the orientation had turned a little bit more towards kind of problem solving and other aspects as the number one priority, as opposed to sustainability, which had been near the top. But again, if you go to infrastructure, you go to private equity, infrastructure again is a way that you can, I'm not, sorry that I've spoken twice about infrastructure here, but again, it's another way. You certainly see portfolios towards renewables and other aspects like that, which again helps with that sustainability point.
Yeah, and I think it's interesting the crossovers between the infrastructure side and the real estate side. Had sessions around, so for example, Iceland and places like that, where you're connecting the airport development with the city and actually beginning to blend those two elements together. So definitely an increase, I think, in those. There's just a couple of minutes left, so I wanted to pick up on, let's say, picking your key trend that you think is going to be influencing the market. What should everybody be thinking about? You can maybe pick two if it's difficult to just pick one. But what's the key trend that you think is going to be influencing the market in 2025? What end shall I start? Who's Tom? Come on.
I'll go first. I'll take the easy one. Interest rates. I think just the trajectory of interest rates and what central banks do, that really shapes the investment environment. Real estate takes its pricing relative to the risk-free rate. So what happens with interest rates? Where do they settle? How fast does the loosening come through? I think that will impact a lot of decision making.
Okay, good. And although Tom has gone first, you can agree with him or have a different view, so that's fine. Yes, Alice.
I mean, I 100% agree with him, although, and I'm not necessarily saying this is my view, but I've heard, earlier on we were talking about strap lines for different expos, and I've heard that 2027 is going to be heaven.
Oh, God.
So, we're starting to see the green shoots this year, coming into next year, and...
Okay, good. That's a long time to wait.
I think, agreeing on the interest rate side, I think one of the other drivers will be the demand bifurcation on quality side, because I think that will, the mid to long term, will be a driver of where liquidity is and where liquidity will be challenged.
Okay, great. And last words to you, Daniel.
I think key theme is a new mindset for core investing. So the indicators of what a core investment is, I think, are being redefined to look more at the resilience of cash flows than maybe what the building looks like.
Okay, great. We've got sessions coming up looking at sustainable logistics coming up next. We'll also be looking at debt. We're looking at ESG and social impact. Also at living, and then finally at student housing, and then drinks. So that's our afternoon. If that matches with your interests, do feel free to join us at any of those. Thanks very much to the speakers for your insights and views. I'm looking forward to Heaven in 27, and we'll be focusing on all of those key topics. Thanks very much to everybody in the room. Thank you to everybody also watching online, and if you're watching on demand, thank you very much for watching.